The first thing you need to understand that we have studied the liability in our earlier accounting papers. And the liability means that it is a present obligation. It is a present obligation as a result of past event and which will result in the outflow of economic benefits. So this is the plain definition of the liability which we have studied in earlier accounting papers. Liability is a present obligation. Now, present obligation means that you own this now, you have to pay, you owe this money to someone as a result of past event. Now, that means you have already entered into a transaction. You are not just thinking to enter, you are not intending to enter, you have already been entered into a transaction, and which is going to result in the outflow of economic benefits. This was the definition which we studied earlier in your basic accounting papers. Now, this liability was pretty sure at that time. Like, for example, when an entity is buying goods on credit. Now, that means this is going to create a liability. Or, for example, they are taking loans. This is going to create a liability. These things were quite simple and logical to understand. But sometimes the entity may have the obligation, which involves uncertainties. Entity may have the obligation which involves uncertainties. Like, say, for example, you have offered a warranty. Now, when you have offered the warranty on your product, for example, that covers the accidental coverage, or for example, if the product gets, it's not working properly, then you're going to repair it or you're going to replace it. So that means when the customer is coming up with the product in the form of claim, then you have to do some expenditure either to repair it or you will be replacing it completely. That is going to be an expense for the company. And that is going to have a cost as well. But you are not sure that whether the product will be coming on the warranty. And if it is coming, it will be for repair or replacement. Or for example, you are not sure how many products will be coming up on the warranty. Now that means you have the obligation in terms that if some phone or whatever product is coming on the claim, then you have to fix it. You have to either repair it or replace it. But you are not sure that how much in terms of the cost you will be bearing. So that means the obligation which is uncertain. Similarly, if there is a litigation, now you actually sold some product to your customer and your customer is not satisfied, or for example, there is some damage which your product has done to them. Now they have gone to the court, they have sued you for that incorrect product you have given to them. Now the court gonna decide. How much damages you are going to pay, because these are the unliquidated damages not mentioned in the contract. The damages which is already mentioned into the contract, which covers the loss, that is liquidated damages. We have studied this thing in the law. But now they are claiming a significant bigger amount from you, but obviously you do not expect to pay that much amount, and you believe that the court will decide how much the amount will be paid. No, you know that you are going to pay something. You know yet you have done the mistake. but you are not sure how much you will be paying when you lose the case in terms of damages. So that means you know there is an obligation, but you are uncertain regarding the amount. Sometimes you are uncertain regarding the timings and when the claims will be coming and whether those claims will be for repair or replacement. So sometimes you are uncertain regarding the timings and sometimes you are uncertain regarding the amount which is going to be paid to settle that obligation. In these cases, it is quite simple. You know, goods on credit, you know, like how much you have bought. So you will be paying simply the amount which you have agreed to pay. When you have taken the loan, this obligation is quite clear. The amount which you have taken as a loan that will be paid as per the agreed contract. But when you are talking about, say, warranties, say, for example, litigations, then you are not sure that regarding the timing and amount you will be paying to settle that obligation. So a liability of uncertain timing and amount is known as provision. Provision is the liability of uncertain timing and amount. I hope it is clear because I have given you two examples. You can take many examples. In fact, there will be many examples coming ahead in these slides. So liabilities are the obligation arising from a past event that will lead to an outflow. Most liabilities can be measured accurately. For example, you took a bank loan. Now, this is quite simple. Provisions, however, involve more uncertainty. So when you're talking about a provision, this is a liability of uncertain timing and amount. So this is provision. Now, we'll be talking about the recognition first. Now, do remember the criteria of the liability which I've explained you here. It is a present obligation as a result of past event that results in the outflow of economic benefits. So the same concept applies over here. A provision is recognized when an entity has a present obligation. Now, remember this thing that it should be a present obligation. This thing is going to clear many concepts for you. It is going to be a present obligation. Like if you are intending to enter into a transaction, that is not going to create a liability because you have not entered yet into the transaction. Similarly, if you think that when you will be entering, you will be paying someone, this does not constitute a present obligation. So they say if it is not damaged, don't fix it. So that means when you have not made any damage, you are not going to regard any liability for it. So an entity has a present obligation. Now the present obligation means that you should be entering into the transaction in order to record a liability. If you are just thinking or if you are just intending, if you are just dreaming, that will not make any sense to record the liability in the provision. Now entity has a present obligation, legal or constructive. Now we'll be discussing this thing in a while. We have a separate slide for discussing legal or constructive obligation. But for now, you can just understand that legal means something which is coming from the law itself. And now the law requires you to do something. When you're talking about the law, laws and regulation, the laws and regulation requires you to do something that is known as the legal obligation. For example, you have an asset which is installed somewhere. For example, an asset is installed on the government leased land. Say, for example, you're extracting something from the land, such as minerals or oil, whatever, and you have installed your machinery over there, assets, the complete set of machinery is over there. And the government says, okay, when your project ends, you have to dismantle the site. You have to dismantle the asset. You have to restore the site when your project ends. Now that means that this is actually a legal obligation because the law says, because the government, they are making the laws, and the government is saying something that is actually law in the regulation. So they are saying because you have installed your machinery, you have actually uh, done some amendments on the land, you have done something on the land, now you have to fix it, restore it to the original position. So this is going to be a legal obligation. Now, the constructive, as the name suggests, constructive, when you are constructing an obligation for yourself, when you are making an obligation for yourself, can we make an obligation for yourself? Yeah, we can make an obligation for ourselves. How we can make it? Like, for example, if we are doing something for years and now the people think that we will be doing that and we are announcing that thing to do. Like, say, for example, you have your operations um in the you have a company and you're producing something and your company is nearby to a residential area, for example. Now the industrial state is a separate state for for the companies, but industrial state means that where all the industries are operating, but sometimes it is quite near. Nowadays the population is extending, sometimes it is quite near to the residential areas. Now, your company has been doing something, for example, regarding the wastages which the industry is making. Your company is a socially responsible company who is just collecting the waste by the day end and actually putting that waste into some, proper designated place where the government has taken some steps or whatever. Now you have been doing this for years, and now you have announced this thing as well, that you are taking care by picking up the wastages. Now this becomes your obligation because you are doing this for years. You have given the impression, you are announcing this thing, you are cashing up this thing. So that means it becomes your constructive obligations. Just like the politicians, when they have some elections, they just announce many things to the people for getting the favors, for getting the votes. Now when they have announced something, that becomes their constructive obligation. Now when they come in the government, when they're elected, so the people require them to do that thing, even that is not being announced. When they are elected, they were that thing were announced before they were elected, but the people expect them to do that thing. So an entity has a present obligation as a result of past event. That means you have already entered into a transaction, and it is probable that an outflow of resources embodying economic benefits will require to settle the obligation. Now, say for example, over here you need to dismantle or restore the site. So when you need to restore the site, you need to spend something on it. So that will result in the outflow of the benefits. Now, benefits mean you will be spending some cash on it, or you will be deploying some resources to fix it, whatever. A reliable estimate can be made of the amount of the obligation. Now, this is something very, very important because when we discussed the term provision, we said it's a liability of uncertain timing and amount. Liability of uncertain timing and amount. Now, when there are uncertainties, so you need to apply your professional judgment to reach a figure. When there are uncertainties, you need to apply your professional judgment. Like say, for example, nowadays we have pandemic. Now the people are asking when it is going to over. And you are someone who is responsible, just to tell the people when it's going to over. So you are just applying your professional judgment to tell them, because the China has recovered within 3 months. So based on that, we can say that we will be able to recover by the end of the May, for example. You are giving this statement. Now, how you have reached to this statement is you have seen someone fixing that problem earlier. And based on that, you are able to reach a conclusion. Similarly, when you are talking about warranties, now warranties is something, like it is uncertain at how many products will be coming on the claim. But you have your past experience of selling the products. Like in the last year, it was 1% of the products came for the claims. Now you have an estimate of 1%. Similarly, like if you are operating in a sector where litigations are common, like for example, if you are operating in a food sector, you have a hotel or restaurant, then the litigations are common, like someone has eaten the food from your outlet and then they're claiming to have a food poisoning from that, and they just went into the court and they have sued you. Now, these cases are normal for you because you are in the industry every time, every year, you just face those cases. So litigation is something, common for you. So when you have litigations common, from your past experience, from the experts which you have hired, like the people who deals with your cases, solicitors, lawyers. Now they're going to tell you every time, look, this is not serious. We know that we're going to win the case. Look, this is serious. We know we're going to lose the case. So they're going to tell you. So that when you have uncertainty, you need to make a professional judgment to reach the conclusion. So that professional judgment is actually a reliable estimate can be made of the amount of the obligation. So like for example, you are offering the warranty. So you will be just assuming, you will be making an estimate, and it should be a best estimate that how many products will be coming for the claim and how much you will be spending to fix it, so that you just estimate the amount which you're going to spend on those claims. That amount is going to be recorded as a provision. If you cannot make a reliable estimate, this thing does not meet the criteria of the provision. You cannot record the provision. If a reliable estimate cannot be made, the provision should not be recorded. This is something you should understand in the first place. If a reliable estimate cannot be made, then you should not record the provision. Now, an entity has a present obligation as a result of past event. It is probable. Now, probable means that it is more than 50% chances and 50 to 95% chances. Because if you go more than 95%, then that becomes virtually certain. So more than 95% means virtually certain. A reliable estimate can be made of the amount of the obligation. This is the recognition criteria. Now you have the measurement. Now the general rule is the amount recognized is the best estimate of the expenditure required to settle the present obligation. We have already discussed this thing in quite detail. Where a provision being measured involves a large population of items, use expected values. Now, for example, warranties. Large population that you have sold thousands of units. How many of those will be coming for the claim? So you have to use the expected values. Like last year it was 1% or 2%, whatever. Expected values. Where a single obligation is measured. Single obligation means, for example, litigation. The individual most likely outcome may be the best estimate. Now you're talking about the particular case, asking from the lawyer that what do you think regarding this case? You're not talking about the series of the cases. You're talking about the particular cases. How much is the estimate that you will be paying in terms of damages? This is the measurement. Now, when you are recording the provision, so what is the double entry to record the provision? Debit, profit, or loss, we book this thing in the financial statement as an expense, and credit provision. Credit provision means this is going to be the obligation. So debit, profit, or loss, credit provision, and provision is the obligation. Now, discounting of provision. Now, discounting means that if you have an outflow which is coming outside the 12 months, if you have an outflow which is coming outside 12 months, now in that case, you are going to record your provision at the discounted amount. Now, discounting means that you have to bring the future value to the present value. Like say, for example, you have now installed an asset and the government says when your project ends after 5 years, you have to dismantle and dismantle this site, you have to restore this site, decommission this site. Now you will be spending amount after 5 years. So what liability, what provision you should regard now? So present value equals to the future value 1 plus r raised to power minus n. So R is the rate of interest and N is the number of years. So what you're going to do is to debit over here. If we are taking, just take an example of decommissioning, for example, decommissioning the asset. Now debit asset because that cost is capitalized, and credit provisions. And then when you have brought the figure to the present value by using a pre-tax rate, then unwinding of the discount will be done. Now unwinding means that now discounting means that you have brought the future value to the present value. You have brought the future value to the present value. This concept is known as discounting. Now obviously when every year passes, you have to unbound your liability so that it reaches the final amount which you are expecting to pay. This concept is known as unwinding. So the double entry will be debit profit or loss and credit provision. Because you have discounted it, when you are taking it to the future value, you will be unbounding it. So debit profit or loss, this means the finance cost, and credit provision because you are systematically increasing your provision. Because with discounting, you have come to a decreased value, a reduced value. Now every year you will be unwinding it. Like for example, you have to pay $100,000 after 5 years. And your discount rate is 10%. Now what we're going to do is present value equals to 100,000 and 1 plus r is 0.1 raised to power minus 5. So can you calculate it for me? 1 plus 0.1 raised to power minus 5. So the answer which you have given to me is 0.620. It's the multiplication thing, sorry. So 0.620, that means 62,000. All right. So the present value of 100,000, which is going to be paid after 5 years, is 62,000. Now this is the present value which you have recorded now. This is the start of year one. Now by the end of year one, 1 year has passed. So what we're going to do is 62,000 multiplied by 10%. It gives you 6,200. So 62,000 plus 6,200. It is going to be 68,200. This is going to be your closing provision. So the double entry is debit profit or loss, credit provision, 6,200. So we have recorded 6,200 as a finance cost, and we have increased or provisioned by 6,200, and now the closing provision is 6,200. So in the next year, the opening provision will be 68,200, and then 10% of it after the end of the second year, we'll be adding that thing. Similarly, after the end of the 5 year, this figure is going to reach 100,000. This is known as the discounting of provisions and how we unwind this thing. Now you have the reimbursements. Now you have the reimbursements. Now the reimbursements is, for example, let me give you a practical example. Let me give you a practical example. You know, sometimes like you are a manufacturing company. You are a manufacturing company and you are making a product. You have a products and these products are sold with warranty to the customers. Now the warranty gives them the right that if they come up with the product, either you will be repairing it or you will be replacing it. So if the customer comes for the claim, then you're going to repair it either or you're going to replace it. And this warranty which you are offering is actually insured from an insurance company. Now you have a set criteria with the insurance company and your claims are insured. If a customer is bringing the product on the warranty, then what you're going to do is you will be filing a claim to your insurance company to pay the amount. Now, they will not be paying directly to the customer. They will be paying that amount to you and you will be paying to the customer. So that means your claims are insured. So that means it gives rise to two things. The first thing is that there is an expected outflow. Outflow is probable. When outflow is probable, that means you need to record the provision. You need to record the provision. Now, provision is a liability. And the amount which the insurance company will be paying to you is actually an asset for you. When they are paying you the cash will be an asset. Or that is going to, in terms of the income statement, is going to be an income. For example, when they will be paying you, you will be recording debit cash, credit profit or loss. And when you're recording the provision, you are recording debit profit or loss, credit provision. So basically, we cannot record debit cash or receivable from insurance company. We cannot offset the asset and liabilities. No offsetting can be done. We cannot offset the liability, which is the provision, with the receivable, which is going to be the asset when it is going to be received from the insurance company. So we have to record it separately. So if the outflow is probable, you are going to record the provision, which is the liability. And if the inflow is virtually certain, now I told you earlier, virtually certain means more than 95%. So if there are more than 95% chances that the insurance company will be paying you for that claim, then you can record that thing as a receivable from insurance company, which is ultimately an asset. But we cannot offset these two things. These are going to be recorded separately. So this is what is written over here. Reimbursement, some or all the expenditure needed to settle a provision may be expected to be recovered from a third party, for example, an insurer. This reimbursement should be recognized only when it is virtually certain that in more than 95% chances that reimbursement will be received if the entity settles the obligation. But you are not going to offset You'll show the provision separately as a liability. And if you are sure that you will be getting the claims, because we have a criteria for with the insurance company. If you think that they will be paying you and the percentage is more than 95%, that means virtually certain, then you are going to record the asset, but you are not going to offset it by any means. Now you have another thing, recognizing an asset when creating a provision. Recognizing an asset when creating a provision. All right. Now, just remember the example which we discussed over here. Decommissioning, dismantling. Like you have a legal obligation to dismantle the asset by the end of its useful life. So we are recording a provision and the asset at the same time. So debit, asset, credit, provisions. So decommissioning or restoration cost is basically an example that when we are recording a provision, we may record a corresponding entry as an asset. Now you have the derecognition. Now derecognition means because you have recorded a liability based on an estimate. So based on the estimate, you have recorded the provision. So this is an estimate. This is not the actual, although it is the best estimate, but this is not the actual scenario. Like for example, you were expecting some claims, but fortunately there were no claim throughout the year. Everything went wrong, although this is going to be a rare scenario, but this is possible in the real life that you offered the warranty, but not even a single product came back for the warranty. Now that means you have to de-recognize the provision. So by de-recognizing the provision means simply reverse the double entry of the provision. So how are you going to reverse it? You recognize provision as a liability, now de-recognize it. So debit provision, this means de-recognition. And credit profit or loss, because earlier you booked the expense, now you will be crediting the profit or loss. So basically this is a reversal of expense. Reversal of expense which you have already recorded. So debit provisions, which is the de-recognition of the provision, and credit profit or loss, which is the reversal of the expense. So this is the de-recognition. If it is no longer probable that an outflow of the resources and embodying economic benefits will be required to settle the obligation, the provision should be reversed, should be de-recognized. So how you are going to de-recognize it? By just passing the reversal entry. Now you have the constructive and legal obligation which we discussed earlier. Now the constructive, as the name suggests, that it is actually based on the actions of the company. They are constructing an obligation for themselves. And legal means something which is coming from the law, which is coming from the regulation, which is coming from the government decision. Constructive and legal obligation. An obligation is something that cannot be avoided because it's your obligation, it's your responsibility to settle it. A constructive obligation arises when entities' past practice or published policies creates a valid expectation amongst other parties that it will discharge certain responsibilities. I gave you the example of the company which is collecting the wastage. Company which is collecting the wastage from the last number of years. From this number of years. And they have announced it that as a socially responsible company, we'll be giving our best in order to create in order to keep the society clean, and blah blah blah. So they are cashing that thing, they are being responsible, they're creating a valid expectation that the company will be doing this thing themselves. So this is a constructive obligation. A legal obligation arises from a contract of laws and regulations. If something is coming from the law, that means a legal obligation. So an outflow of economic benefits is regarded as probable if it is more likely than not to occur. Only in extremely rare cases it is impossible to make a reliable estimate. Like every time you are able to make, you know, a reasonable estimate. Like for example, warranties, you can make an estimate. Litigations, you can make an estimate. Then you have the restructuring, you can make an estimate. When you have when you are damaging the environment, you can make an estimate. It is quite, rare that there will be situations where you are unable to reach any figure. You do not have any input, um, which can, make you reach to a particular figure. So that is going to be extremely rare cases, extremely, uh, you know, um, difficult, that you are putting yourself into a condition where you are not able to make any estimate. All right, now we are going to discuss an example, and this will clear the concept that whether to record the provision or not. Now, Clean sells domestic appliances such as washing machines. On 31st December 2001, Clean decides to start selling washing machines with the warranty. Now, we have already discussed then when the company is offering the warranty, that means there is a possibility, there are chances that some machines will come for the claims, either for the repair or the replacement, whatever the warranty is being offered. Now, when a machine is coming for a repair or the replacement, there's going to be a cost of the company to fix that issue. Like, for example, if they're repairing that, they will need to spend something on it. If they're replacing that, that is completely a whole expenditure. So there is an outflow which is probable. And according to IAS 37, if the outflow is probable, provision should be recorded. Now, we have already discussed few things, like there's levels you need to understand, and this is something which is coming from your earlier knowledge as well. Virtually certain, we have already discussed this thing. And then you talk about probable, and then there is possible, and then there is remote. So when you are talking about virtual certainty or virtually certain, that means it should be more than 95%. Like we talked about, like if there is a provision which is backed up by an insurance, now you can record the asset or receivable from the insurance company only when it is virtually certain that you are going to receive those claims. When you are talking about probability, it is 50 to 95%. When you're talking about the possibility, it is 5 to 50%, or you can say 5 to 49%, and then remote is less than 5%. So remember this thing when you're talking about the outflows. Remember, when you're talking about the outflows, if the outflow is virtually certain, then you record the provision. Even if it is probable, you record the provision. If it is possible, there is no need to record the provision. Instead, you disclose that thing as a contingent liability. And in terms of reportness, there is no action. So remember, this is the case when you have the outflows. All right. Under the terms of the warranty, Clean will repair washing machines at no charge to the customer if they break within the warranty period. So there is a warranty for repair. The entity estimates based on the past correspondence with customers that 20% of the washing machines sold will require repair within the warranty period at an average cost to the clean of $50 per machine. Now 20% of the total sales will be coming back for the repairs, and on each repair $50 will be spent. Clean sold 200 washing machines. Now that's simple. 200 machines multiply by 20% and then you multiply it by $50. That is going to be give you a whole estimated charge, because when we are talking about the provision, it is actually an estimate. So on the next page you have the solution. $2000 will be recorded as a provision. So what is going to be the double entry? Debit profit or loss, because we're going to book this as an expense or loss in the statement of profit or loss, and credit provision because this is actually a liability. 2000. Now we'll be discussing the specific types of provision. Now these are the special circumstances, these are the specific types of provision, the specific cases, the specific circumstances. And this is really very important to understand, because in the exam you may have different scenarios from it. Future operating losses. Future operating losses. Now, before discussing future operating losses, you need to go back and see what was the definition of the provision we discussed, or what was the actually criteria which we discussed. Let's go back and see what we discussed. We had a good discussion that when you want to record a provision, first of all, there should be a present obligation as a result of past event. Present obligation as a result of past. When we are saying present obligation, that is something that you own that liability, you owe that liability. Like say for example, I have purchased the goods from the creditor. Now this is my present obligation because I have to pay them, and this is as a result of past event because I entered into a contract with them. If I am thinking to enter into a contract, then that will not constitute a present obligation because I have not entered into the contract yet. The second thing was that the outflow is probable, which we already discussed, and then a reliable estimate can be made. This was the thing which we discussed in quite detail at that time. All right. Now again, coming back, future operating losses. Now you are thinking that maybe in the future you will be having the losses. Maybe in the future you are having the losses, but there is no obligation. There are no contractual losses. You are just thinking that in the future there will be operating losses. So no provision is required for that. Now why is that? Because this does not meet the criteria set out in the standard. Because if you want to record the provision, there should be a present obligation as a result of past event, which will result in the outflow, and a reliable estimate can be made. So when you are thinking in the future you will be having the losses, although you can say based on some circumstances, consequences, based on some information, but again there is no contractual thing that you owe a liability towards those future operating losses, because this is just an estimate. You can avoid those losses by you shutting down your business. If you shut down your business now, you can avoid those losses. So that means there is no contractual loss. But now we'll be talking about the contractual losses, which is something known as the onerous contracts. Now, onerous contracts means that these are the contracts which are going to incur the loss. Now, whenever we talk about these situations, some student asks, sir, why we will be entering into a project, or why we'll be entering into a contract which is going to make a loss. Obviously, we are not going to enter into the contracts which make the loss, but sometimes it is actually a compulsion. Let me give an example. Say, for example, I submitted a tender for a government project, or contract. Now I quoted the prices within the contract. So this was a fixed price contract. That okay, the things the government is looking for, the assets they are looking for, I'll be providing them those assets within this much price. I gave them the contract price. So this is a fixed price contract. But my bad that the prices gone up significantly. Now, because I have given the price to the government, now I cannot step back. I have to provide those goods to the government in that price. Because if it was a cost plus contract, then I would have, just survived from the losses. But because this is a fixed price contract, I cannot step back. So that means the prices have gone up and I gave the less price. Now I have to bear the loss. So onerous contract means if there is a contract and a loss is expected. Now this is a contractual loss I'm talking about. I'm already in the contract. Now I cannot avoid that loss. In the future, in the previous example, when I was discussing the future operating losses, I told you that you can avoid the future operating losses if you just shut down your business now or you sell your business to another person. Now that person will be responsible for dealing with the losses. But in the onerous contracts, you cannot avoid the losses since you have to provide the government with those goods in the example I have given you. Now that means this loss is unavoidable. So IAS 37 says, IAS 37 defines an onerous contract as one in which unavoidable cost of completing the contract exceed the benefits. That means whatever you are receiving is less than what you are investing. So that means there is a loss. Unavoidable cost of meeting the obligation are lower of cost of fulfilling the contract, penalties from the failure to fulfill the contract. Now, because there is a loss, either I'll be fulfilling the contract or if I'm avoiding the contract, I have to pay the penalties for it. So whatever is that, we take the lower. An example may be a fixed price supply contract related to a particular product due to inflation now cost more to manufacture than the fixed sale price, the example I have given you. If an entity has a contract that is onerous, the present obligation under the contract must be recognized and measured as a provision. So this is something you need to remember. And then there is another concept which is known as onerous leases. Onerous leases. This is similar to the onerous contracts. That is why we are discussing under the same head. Now, onerous leases means that an entity has taken an item on a lease. They are making the lease payments, but they are not taking any benefit from that asset. Again, onerous leases means that an entity has taken some items or assets I'm talking about on lease. They are making the lease payments, but they are not taking any benefit. Like sometimes, for example, you were thinking that you'll get the contract and then you bought some asset on lease for that contract, and then unfortunately you didn't get the contract as well. Now because you have already entered into a lease contract, you need to pay the lease payments, but you are not getting any benefit from it. A lease agreement that becomes onerous is only within the scope of IAS 37 and therefore results in the creation of provision, because now you are actually making the payment. So if the simplified accounting is applied so that no lease liability has been recognized, this is only the case where a lease is a short term or for an asset with a low value lease. Now, if you remember IFRS 16 leases, There we discussed two types of leases, short-term lease and low-value lease. And this was in addition to the normal leases, the right of use we were discussing over there. Short-term leases, which is 12 months or less, low-value leases such as tablets and mobile phones, LEDs, etc. Now, there was an exemption for this short-term and low-value leases over there. That entity can choose to expense this out on a straight line basis rather than capitalizing this thing as a lease as a right of use in the statement of financial position. So if an entity is having a short-term lease or a low-value leases which is not recorded as an asset in the statement of financial position, they are making the payments, but they are not getting any benefit from those assets which they have taken on the lease, then this should be recorded as a provision. This is actually a loss they are making, and this should be recorded as a provision in the statement of profit or loss and the statement of financial position. So this is known as the onerous leases. Now, onerous contracts means that if there are contracts which are making the loss, then a provision for loss should be recognized. And similarly, if there are onerous leases, but this applies to the short-term and the low-value leases specifically, so they are making the payments, but they are not getting any benefit from it, then that means this should be recognized as a provision. Now, we are continuing the specific types of provision, and under the specific types of provision, we are discussing the future repairs to the asset. Now remember this thing that this has the same logic as future operating losses. Now future operating losses means that you think that there will be losses in the future, but I told you you can avoid these losses by selling your business or by shutting down your business. Similarly, when you have an asset and some repair may be required in the future, such as like in case of overhauling, planes are required to go for major inspection every few years. Now again, there is no current obligation because you can avoid this obligation by selling your asset to someone. Like what if I have an asset and okay, I have to overhaul it, I have to do the major inspection after every 2 or 3 years. But what if I sell it even within a year? So that means provisions cannot be recognized for future repairs to the asset because an entity can avoid this obligation by simply selling their asset to someone. So far what is clear to us is that we are going to record the provision for the unavoidable cost and unavoidable losses. If we are able to avoid the losses by any means, by transferring it to someone, by selling your business, by selling your asset, then that means it does not fall under the criteria of the provision because there is no current obligation. So there was no provision related to the future operating losses. And yes, there is going to be a provision for the onerous contract. There's going to be a provision for the onerous leases if it is particularly related to the short-term and the low-value leases. And no provision should be recognized for future repairs to asset. Now we have an example. Danboy is a company that owns several shops which has a year end of 31st December 20x1. One of the shop is loss making. At 31st December 20x1, Dan Boy forecasts that this shop will make a loss of 50,000 in the year ended 31st December 20x2. Now they think there's a shop which will make the loss in the next year of $50,000. As at 31st December 20x1, one of the shop building requires repair. The cost has been reliably estimated at a reporting date of $10,000. The repair is made in the following accounting period at a cost of $12,000. Discuss the accounting treatment of the above in the financial statements. Now they have the shops. They think one of the shop will be making a loss of 50,000 in the next year, and then there is a building which requires repairs, and the estimated cost is 10,000. IAS 37 states that no provision should be made for future operating losses Therefore, no provision should be recognized because I told you that there is no present obligation. No provision should be made for the future repairs despite it is being probable of capable of being reliably measured. This is because there is no obligation at the year end. The repair expenditure of 12,000 is expense to the profit or loss as it is incurred. So this is something you need to remember, that there will be no provision for the future operating losses. There will be no provision for the future repairs. Under the new legislation, an entity is required to fit smoke filters to its factories by 31st December 2007. At the reporting date of 30th June 2007, an entity has not fitted the smoke filters. Should a provision be made? Now, by law, they are required that they have to fit the smoke filters by 31st December 2007. Their year end is 30th June. That means this obligation is coming up within next 6 months. Now, most of the times you will be having an example which give you some flavor and creates a confusion that whether the obligation should be recognized. Because here in this example, they say that that obligation will be coming within 6 months. And similarly, in the previous example, which we discussed, Dan Boy, within 12 months, there were future operating losses, and within 12 months, there was actually the repairs. So it actually creates a doubt whether the provision should be recognized. Now, what about the smoke filters? Again, no provision should be made for this future expenditure, despite it is being probable and capable of being reliably measured. There has no obligation. Right now, at 30th June, there is no obligation. They have to fit that thing by 31st December. Now, what if they sell their company before that? Obviously, they can avoid this thing. So that means it should not be recorded as a provision at 30th June. Now we'll be talking about the environmental provisions. Again, this is a specific provision we are talking about, environmental provisions. Now, many companies which are operating, they have the environmental footprints. So you probably have heard this term, environmental footprints. Environmental footprints. In simple words, it is actually environmental impacts. When we use the environmental footprint, now footprint is actually a general term. It can be positive, it can be negative. Impact can be positive, impact can be negative. For example, if you're growing up the trees, if you're planting the trees, then this is a positive impact. But if you are cutting the trees, you are using the non-renewable natural resources, this is a negative impact. But when we talk about the footprint, it is actually considered as a negative impact on environment. Negative impact. Like for example, you are doing the production and you are uh, like emitting the carbon dioxides, or for example, you are using non-renewable natural resources, or for example, you have been doing some activities which is causing damage to the seashores, causing damage to the environment. Now, if you have been involved in such activities which is creating any type of harm or the damage to the environment, and you are required to fix it, like say for example, you are actually you have actually a plant, for example, in the sea, and you are extracting the oil. Now the government says, okay, extract the oil, but when you are done with this thing, you have to restore the site. You have to fix the damage you have done. Now that means in order to fix the damage, in order to restore what you have done, you have to spend something on it. It can be a decommissioning, cleanup cost, restoration cost, whatever you call it. In that case, you have to record the provision for that. So environmental provisions are often referred to as cleanup cost because They usually relate to the cost of decontaminating and restoring an industrial site after production has ceased. A provision is recognized if a past event has created an obligation to repair environmental damage. A provision can only be set up to rectify environmental damage. Now you have to fix it. You have to fix the impact, fix the damage you have caused. There's no obligation to restore future environmental damage. You're just talking about the damage you have done. You're not talking about the damage which can be done in the future. Again, no provision for the future damage. Merely causing damage or intending to clean up the site does not create an obligation. This is an important point you need to understand. If you have been involved in such activities, but you do not have any obligation from the government, from any contract, that you have to fix this damage, then there is no obligation and no provision should be recognized. Even if no one is telling you, but you yourself has the intention, then again, no provision should be recognized. But there is one point. If there is constructive obligation, now from your past practice, from your announcements, from your publishments, from your disclosures, you have given a flavor to the public, you have given the flavor to the relevant authorities that okay, you voluntarily will be cleaning up all this thing, all the mess you have created, then again that will become your constructive obligation. In that case you have to do that. So an entity may have a constructive obligation to repair environmental damage if it publicizes policies that include environmental awareness or explicitly undertakes the cleanup damage by its operation. And now if you are taking the responsibility yourself, you are advertising it, you are taking the benefit from the advertisement, you are publishing it, you are actually showing your ethical behavior towards that. Now that actually creates the constructive obligation. In that case, you have to fix it. So continuing the environmental provision, the full cost of environmental provision should be recognized as soon as the obligation arises. Now you know that you are doing the activities which is doing the damage, so you should record the provision for that, and the provision represents the amount you will be spending. The provision represents the amount entity will be spending to fix the damage cause. So the effect of the time value of money is usually material, therefore environmental provision is discounted. Like for example, if you have to fix it after 3 years, now the estimated value should be discounted. If the expenditure results in future economic benefits, then an equivalent asset can be recognized. This is depreciated over its useful life, which is the same as the life of the provision. Now, this is again very important point to understand. If the expenditure results in future economic benefits, like for example, you are causing the damage, but again, whatever is being done, that will be received to you by some means. For example, that either that is being insured, or for example, any other relevant authority will be paying you some amount for it. You're actually that damage is being covered by some other organization. Now, on the one hand, you have a liability. You have a liability to fix it, which will be recorded as a provision. On the other hand, you will be receiving that amount from someone. So that is creating actually an economic benefit. So that is actually an asset which you will be recording in the statement of financial position. But again, we cannot offset the assets and liabilities. These should be presented separately. Now you have an example. An entity has a policy of only carrying out work to rectify damage caused to environment when it is required to do so by the local law. For several years, the entity has been operating an overseas oil rig which causes environmental damage. The country in which oil rig is located has not had legislation in place that required this damage to be rectified. A new government has recently been elected in the country. At the reporting date, it is virtually certain that legislation will be enacted that will require future rectification. This legislation will have a retrospective effect. Now, the retrospective means when the legislation is coming, even the current contracts even the current contracts will be required to fix the damage. This is the A requirement. So currently there is no law, but there is a law which is coming up, and if the law is coming, that will require the damage to be fixed. Under a license granted by a local government, an entity has constructed a rock crushing plant to process material mined from the surrounding area. Mining activities have already started. Under the terms of the license, the entity must remove the rock crushing plant when mining activities have been completed and must landscape the mined area so as to create a national park. For each situation, explain whether a provision should be recognized. Now, in the first, which is the A part, currently there is no law, but a law is coming. The law will be having a retrospective effect. That means even the current contracts will be obliged to fix the damage they have done. In the B part, there's an existing obligation with the contract with the local government that when you are done with your mining activities, you have to restore it and you have to make it the thing as a national park. Now, the first thing you need to see again is the criteria of the provision. For each situation, ask two questions. Is there a present obligation as a result of past event? Is an outflow of economic benefits probable as a result? A provision should be recognized if answer to both questions is yes. In the absence of information to the contrary, it is assumed any future cost can be estimated reliably. Now, this is something you need to understand, that you have to apply the criteria of the provision. Whenever you are establishing whether a provision should be recorded. In the A part, is there any present obligation? Yes, because the new legislation with retrospective effect is virtually certain to be enacted. That means more than 95% there are chances that the law is coming and that will affect even the current and the previous contracts. The damage caused by the oil rig is the past event that gives rise to a present obligation. Outflow of economic benefit, yes, because you have to fix it. So conclusion, record a provision because there was a virtual certainty that the law is coming and that have a retrospective effect as well. Now in the B part, is there any present obligation? Yes, because you have a contract with the government. It will result in the outflow. Yes, so a provision should be recorded in both of the circumstances. All right, now we have discussed that if the expenditure results in the future economic benefits, then equivalent asset can be recognized. Now, the first perspective we discussed was that okay, like if the damage which you are causing is covered up by an insurance, for example, or you will be compensated by that amount by someone. Now, or by any means, you can record the asset. The second perspective of that is like whenever we are talking about restoration cost, whenever we are talking about dismantling cost, or whenever we are talking about decommissioning cost. We know from the principle of IAS 16 that these are actually capitalized as part of the asset cost and again depreciated systematically. So this is the second perspective and the main perspective of this point, which is written over here, that if the expenditure results in the future economic benefits, then obviously this restoration cost or dismantling cost or decommissioning cost should be capitalized and then is being depreciated over its useful life. Now we have an example to understand this concept. On 1st January 2006, Scrubber spent 5 million on erecting infrastructure and machinery near to an area of natural beauty. So they made an initial expenditure of infrastructure and machinery, which is actually their non-current asset, and the amount is 5 million. These assets will be used for over the next 3 years. Okay, so useful life is 3 years. Scrubber is a well known for its environmental friendly behavior and is therefore expected to restore the site after its use. So that means constructive obligation. The estimated cost of removing these assets and cleaning up the area on 1st January 2009, that means after 3 years, is 3 million. Now this is actually an estimate of 3-year cost. Now that means we need to discount this amount. Discount this amount because this 3 million belongs to after 3-year payment. The pre-tax risk specified discount rate is 10%. Scrubber has a reporting date of 31st December. Now you remember the discounting, we have already discussed that thing in the earlier lecture of this IAS 37. It says that whenever you want to calculate the present value, it's future value 1 plus r raised to power minus n. So here future value is 3 million. 1 plus r is 10% raised to power minus 3. So this will give you the amount which should be capitalized as part of the asset cost. So what you're going to do is debit asset, credit provisions. So whatever your asset initially is the cost is 5 million and plus dismantling, whatever this amount is, this will be the total asset. And this present value, then there will be unwinding, if you remember, because we have to take the discounted value to the future value systematically. That is known as the unwinding. Now this is the answer. So first of all, the present value of this 3 million is 2253,000. That means 22 lakh and 53,000. So 3 million, which is 30 lakh. The present value is 2253,000, 22 lakh 53,000. So debit PPE because this will be capitalized as part of asset and according to the principle of IAS 16 because it creates a future economic benefit. And similarly, you will be having the provision, but this provision is then unbounded. So 2253 is actually the opening balance, and then you add the 10% of it. The closing balance is 2478. This becomes the opening balance of next year, then 10%. Similarly, then this, and then this. This is the unwinding which we have already discussed in detail. Now, the cash paid for the basic infrastructure is 5,000. Now, this 2253 will be capitalized as well. So the total cost is 7253. Now, this 7253 will be depreciated over the 3 years. So per year depreciation is this, and this is unwinding, which is recorded as a finance cost every year. Now you have a restructuring, which is very, very important when it comes to IAS 37. So if I say this is the most important area, this won't be wrong. So this is the most important area of IAS 37. So mark it with yourself that you can expect this thing every time in your exam. And it has already been tested in SBR. Restructuring. Now, restructuring is a program that is planned and is controlled by management and materially changes either the scope of the business or manner in which business is conducted. Now, many companies has gone through restructuring. Like for example, if they are changing the products, like you talk about the Ford, you have heard regarding the Ford, they used to make the trucks and then they started making the cars. So there are many companies who have changed their products, they have changed their locations, they have changed their business models, they have changed their management structures. So if any type of these changes is coming within the company, either in the form of product, in the form of location, business model, or for example, the management structure, then this is known as the restructuring. Now, whenever there is a restructuring, there is a criteria. For restructuring, IAS 37 has a particular criteria. And this is an important thing to remember. Now, the first thing you need to understand that why this restructuring is being discussed under IAS 37. Why not the other standard? Because whenever the entity is doing the restructuring, there will be certain costs associated with the restructuring. For example, redundancies. Like if they are making some employees redundant, for example, they are shutting down some of their division, they're shutting down some of their department and they're making people redundant. So they have to pay them the redundancies. That means severance payments, which you have studied in your law papers, severance payments. Similarly, there may be lease termination cost if they have already taken some assets on the leases and now they're terminating. So there will be lease termination costs, loan repayments costs, etc. So there are some certain outflows which are attached to the restructuring. And these payments, either whether they are redundancies, whether they are lease termination, loan repayments, they are coming when you are doing a restructuring. So that means you should record a provision for these outflows. That is why we are discussing this restructuring under IAS 37. That there will be some outflows which are associated with the restructuring and they have been arised as a result of restructuring. That is why a provision is required for those costs. But the criteria, first of all, is that entity has a detailed formal plan. Whenever you're talking about a restructuring, first of all, there should be a formal plan. Now, when you talk about a formal plan, that means something which is discussed in the board by those charged with governance. With the shareholders. And then the second point is that the affectees have been communicated. Now, those who will be affected by the restructuring, they have been communicated. Like for example, employees, if they are, you are making them redundant, so you have told them that okay, we are making redundant, such as lease company which is going to be affected, so you have communicated them, okay, we are terminating the lease. So first of all, there should be a formal plan, and secondly, that plan sorry, has been communicated to the affectees. So whenever there is a formal plan and that formal plan has been communicated to the affectees, a provision should be recognized. Provision should be recognized only for direct amounts, the amounts which arise as a result of restructuring, such as this. So a restructuring provision includes the cost, only the direct expenditures arising from restructuring, which are those that are both necessarily entailed by the restructuring, not associated with ongoing activities. So not associated with ongoing activities such as sunk cost, which has already been occurred or incurred, irrelevant cost. The provision should not be recorded for retraining, marketing expenses, investment in new systems, future operating losses, profits on disposal of assets. So provision should not be recorded for these and should be recorded for redundancies, severance payments, lease termination cost, loan repayment cost, etc. Now you have an example. Trailer, a public limited company, operates in the manufacturing sector. During the year ended 31st May 2065, Trailer announced two major restructuring plans. Remember this thing, this is going to be an important area in the exam, so make sure you are just be attentive in uh, this lecture and while doing the case studies. The first plan is to reduce its capacity by the closure of some of its smaller factories, which have already been identified. This will lead to redundancy of 500 employees who have all individually been selected and communicated with. The cost of this plan are 9 million in redundancy cost, 4 million in retraining cost, and 5 million in lease termination cost. The second plan is to reorganize the finance and information technology department over a 1-year period, but it does not commence for 2 years. The plan results in 20% of the finance staff losing their jobs during the restructuring. The cost of this plan is 10 million in redundancy cost, 6 million in retraining cost, and 7 million in equipment lease termination cost. So there are two plans. The first plan is the closure of the factories, 500 employees, all being communicated. So 4 million is the 9 million is the redundancy cost, 4 million is the retraining cost, 5 million is the lease termination cost. Second plan is to reorganize the finance department, but it is not going to commence for 2 years. Discuss the treatment of each of the restructuring plans in the financial statements of Trailer for the year ended 31st May 20X5. Now this is simple. When you're talking about plan 1, so first of all, you just remember the criteria. A formal plan communicated to affectees, communicated to stakeholders. That will be a better term to use. So is this their formal plan? Yes. The plan is communicated to stakeholder. Yes, we are talking about the plan 1, which is the closure of factories. Right? So if the criteria is met, then the provision should be recognized only for the direct amounts. So provision for direct amounts. Now the direct amounts are redundancy cost, no retraining, and lease termination. So 14 is actually the cost. So debit profit or loss, credit provisions. A current liability because this is planned within 12 months. Now you have the plan 2. This will not start in the 2 years, and so that means there's no formal plan, there's no evidence that the employees are communicated. So no provision should be recognized for plan 2 because it was clearly mentioned in the question that it does not commence for 2 years, and no evidence that the people have been communicated. They have just a general criteria that 20% of the finance staff losing their job. Now, who are those 20%? Are they communicated? No, this is a general criteria. So Plan 2 does not meet the definition of IAS 37 for creating the provision. Similarly, you have another example which you can look at yourself, and that will describe the restructuring thing. I have included many examples further. You can just go through those examples and you can easily identify that which cost to be recognized as the provision. Now you have the contingent liabilities, which is very, very important. And I have already communicated to you. Let's go back to the slide where I just made a chart. Where is that? Yes, over here. We were talking about the outflows. Virtually certain, probable, possible, remote. And now let's go back to the same slide. We are talking right now, that is contingent liability. Again, let me draw the same thing over here in the contingent asset. So first of all, there is virtually certain. Then there is probable. Then there is possible. And then there is remote. In terms of percentage, it is more than 95%. And then it's 50 to 95%. And then it's 5 to 50% or 49%, whatever you call. And it is less than 5%. Then you talk about the inflow and then the outflow. If the inflow is virtually certain, such as you have some provisions, but that are being insured by an insurance company, and now it is virtually certain that you will be receiving the payments from them, you can record the asset. But if the inflow is probable, not virtually certain, then you can disclose that thing as a contingent asset, but you cannot record the asset. If the inflow is possible, no treatment. If the inflow is remote, no treatment. If the outflow is virtually certain, then certainly you have to record the provision. Similar is the case with probability, you have to record the provision. But if the outflow is possible, then you should disclose the contingent liability, but you cannot record the liability itself. And if the outflow is remote, then no treatment. This is what you need to study. A contingent liability is defined: a possible obligation that arises from past event whose existence will be confirmed by the outcome of uncertain future events which are outside the control of the entity. Now, say for example, there is an ongoing litigation going on the company. The case is in the court. Now the court will decide what's going to happen. This court case is not under the control of the entity. They are uncertain regarding the outcome. A present obligation arises from the past event but does not meet the criteria for the recognition of provision because the outflow is not probable. Here the outflow is possible. So a contingent liability is disclosed rather than recording a provision. Similarly, you have the contingent assets. That means a possible asset that arises from past event whose existence will be confirmed by uncertain future events. For example, your inventory has been damaged and you have filed an insurance claim, but you are not certain whether you will be receiving those claims. But the inflow is probable, so you can disclose the contingent asset, but you cannot record the asset itself. So this was your IAS 37.